Hey everybody, welcome to Korean Atlanta Mentorship. Here we talk about velocity banking. And if you don't know what velocity banking is, it's basically putting your whole paycheck into a line of credit. And a lot of people say, "Wow, this is really obvious." And everybody should know this. Like, oh, if you don't make more than minimum payments, you pay a lot of interest. And if you look at TikTok, you'll find an endless number of videos where people just realize that what they don't know, right? Just like this video. I just found this with a TikTok search. Georgia McKilly. Let's go ahead and see what's going on here. Georgia.
Cried. I just cried with my mom because I just realized how credit cards work. And I'm a smart person and I have no idea how I did not understand this. I'm going to share because I cannot be alone. I'm hoping I'm not. I was just looking at my credit card balance and I was kind of confused that it was what it was. And so I looked at my transactions just like over the past several months, and I should have been looking at them more often, but I was not because I'm not a huge spender and I'm pretty good with money, or so I thought. And I see all these like interest charges and I'm like, what the hell? Like why have I been being charged all these interest charges if I pay every month? So I was only paying the minimum every month. I thought that, is that not logical that the minimum, like you just have to pay the minimum every month? So I've only been paying the minimum every month. And I have had the amount that I could pay the whole thing, but I just wasn't because that would be like all my money. So I've just been paying the minimum every month. I didn't know you had to pay at least what you spent that month. I don't know if that's like stupid that I didn't know that.
And that's literally what velocity banking is about, doing the opposite of what she talks about.
Call me stupid, I don't care. But I was only paying the minimum, which was like often $65 every month. And so now for the past like year, every month, I've been charged like 50, 60, $70 of interest when it could have been avoided. I just didn't understand how credit cards worked. I hate money so much. Like, I'm so frustrated because that could have been avoided. I had the money to pay the what I needed to every month. I just was not correct on what I was doing. I was only paying the minimum because isn't that what minimum means? It's like the least amount you have to pay. And then my mom was explaining to me, well, Georgia, that's how companies, credit card companies make money off of stuff like this. But I thought they just made money off of when people didn't pay at all.
No, people who don't pay our who don't pay at all are company's worst nightmare. Actually, I like this comment. You are a credit card company's dream, right? All right, so let's go ahead and get started with velocity banking. Okay, so what is banking? It's basically a debt payoff strategy where you don't make minimums on your payments. And we're going to throw all of our money into debt. So I used this example last time, but we're just going to do it again because I believe in that Bruce Lee saying that if I do one kick 10,000 times, I'm much scarier than a person who does 10,000 kicks once, right? And so a lot of people, when you show them this, you see, oh, $8,000 is really good. And I think $8,000 a month is about around 140,000 a year after tax. And you only have $52 left over because you have all this debt, right? So let's just take a look here. You have all this debt, 10 credit cards, auto loan, mortgage, and on top of that, you have your personal expenses, right? And then what you do here, right, is we're going to do this, and then we're going to copy and paste here, and we're going to do the exact opposite. So you know how she was like, well, I had the money and I just didn't think it was a good idea to dump all my money into the credit card because that's, she doesn't understand, or she probably does to a certain degree, that you could just reuse that level. There's a revolving nature of credit cards and lines of credit. And so what we're going to do is dump all of our money, right? Dump all of our money into a line of credit, and so even though we're not saving money, we're going to increase this cash flow number, right? This cash flow number is the amount that our debt decreases, and we're not going to save money. And so that's what we're going to do, right? And so we're going to assume two things. That one, we have access to a something called a line of credit. So what is a line of credit? It's basically a financial tool where you can borrow money, use it back, and then pay it back, and then use it over and over again. So there's personal lines, home equity lines of credit, credit cards, right? Credit cards are a little bit more restrictive, but it is a line of credit. But we're going to assume we have access to a $200,000 home equity line of credit because we are a homeowner. Now, if you only have $52 left over, will the bank give you a $200,000 home equity line of credit? The answer to that is no, because banks don't lend money to people who need it. So this lady over here, she was like, hey, um, I thought banks, they make money off of people who don't pay. No, 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 no. People who don't pay are bad people to the bank because they can't make any money off of it at all. See, the bank wants people who make money but just make minimum payments on everything. And we have a name for that phenomenon called the segregation of income effect. So what does that mean? Basically, you have $8,000, right? And then you come in and it comes into your checking account and gets split all over the place. And it's not going to be as effective if it's just in one place. So that's essentially what we're going to do. So first thing we need is home equity line of credit. And second thing we need is just to calculate something called the cash flow index. So what is that? Basically a formula where you divide the amount of debt that you have divided by the payment, and then it gives you an arbitrary number, right? And so you see 20 to 237. So think of this as a debt ranking system, right? Debt payoff order. The lower the number, the more bang you get for your buck, right? The lower the number, the more bang you get for your buck. And so if you take a look right here, this is $30,000 of debt. If I pay this 30,000, I get 1050 in my cash flow, right? Whereas if I pay this $220,000 of debt, right? 220,000, um, I only get $927 back in my cash flow. So from a mathematical perspective, it makes sense to pay off your credit cards first than it does your mortgage. And I think people are intuitively aware of this because they see this big, huge 30%. They're like, I want to pay it off first, right? And so this is an easy way to figure out the how to, what order do you pay off the debt, right? So what we're going to do is we're going to move these low cash flow index numbers into this home equity line of credit. And even though you need money and the bank wouldn't give you this free and clear home equity line of credit, why do I demonstrate it like this? Because it's easy for me to show the impact that having a line of credit would have. So basically, you're just transferring debt. So think of this as like a balance transfer, right? So let's say that you take these credit cards, okay, all 10 of them, and let me just kind of calculate this 5, 8, 15, 27, 37, 10, 35, 12, 15, right? And then I'm going to do this, and that's 164,000, okay? So that's $164,000, and we did a balance transfer. Well, guess what happens here, right? Well, oh my goodness, didn't all these credit card payments just go away? And so here, same income, right? $8,000, same $8,000, but if we change just the flow of our banking, we can somehow magically turn this $52 left over to $5,213, and we're not in so much pain anymore, even though we have the same amount of debt, right? Obviously, it really helps to have a high, move from high interest to low interest, right? 30% to 8%. But we also want to have control of all of our money because one of the reasons why we may not want to move all these credit cards into, let's say, a consolidation loan is because once we put our money into a loan, then we've essentially lost access to that money, right? If you overpay a loan, you can't really get it back. If you overpay a line of credit, then you can easily access that money. So let's go ahead and do this right here. So I'm just going to do this. And what we're going to do is take the previous month's balance, previous month's interest, and minus our cash flow. Because why? Because the next step or the final step of velocity banking is once we transfer some of our debt, we put our entire $8,000 paycheck into line of credit, take our expenses out, and then rinse and repeat over again. So 8,000 in, 2,700 out, and then after every single month, 5213.1, right? And then what we have to do is calculate the interest based on the average daily balance, right? Multiply by the interest rate, which is base 0.08, and then you divide by 12. And then what I'm gonna do is copy and paste, right? Copy and paste. And then you just repeat this every single month. And I'm gonna go ahead and do that. And so right now, I'm going to um, highlight this. So we see that in 36 months, we've essentially paid off all our debt, right? So 36 months. And then, what do we do here? How much did we pay off? We paid off 164,000. So now I just put 164K. I'm going to copy and paste here, right? 164,000. And then now we have two more loans, okay? So what we're going to do is with these loans, calculate the current balance. And so 36 months with this loan calculator, we just put the current month here, 36, and then it tells us the current balance. And then we just use the cash flow index again. So 23, take the lowest ranking one, move it into the line of credit. I'm going to go ahead and copy and paste this here, and then we're going to move that into the line of credit plus 8361.18. Okay. And what we're going to do here, right, is this auto loan will turn to 0. Okay. And then we see that even though we've increased our cash flow, um, we don't even really need to update it because we see in the 37th month the auto loan is gone, right? So let me just go back here. Copy the $5,572.47 cash flow. And then I'm going to do this 5572.47. Okay, so now this is our new cash flow, right? So copy and paste, and let me go ahead and not highlight this. And so that's 37 months. So in 37 months, so just one more month, we paid off the auto loan. So that's 164 plus 20. Okay, so that's 184,000. All right, and then that last one is the mortgage, so 37 months. So I just got to type 37 here, and then we see that we paid off only about how much? It's 220,000. After 3 years, we paid about 15 grand of the loan. And so now what we're going to do is focus all of our free cash flow into the loan. And most important thing that we have to understand is that we have to pay this off last, right? We don't want to pay this off first because again, you give the mortgage company 220,000, yeah, your home's free and clear, but you only get $927 back in your cash flow. So you just do this two ways. You could just dump the entire 5,500 left over into the loan, or another way you can do it is just use a line of credit, right? So there's this thing called chunking where you just move a piece of a loan into the line of credit and then dump all your money in over and over again, right? So how does this look like? So let's say that we move $8,000 of the loan, and this isn't totally accurate, into the line of credit, right? Oh shoot, did this get paid off? It already got paid off in month one. Yikes. Okay. No, actually, did it not? I don't think it did. Hold on. Yeah. Yeah, I don't think it did. All right, so now we just do this here, right? Move another 8,000. Oh, I can't even do this correctly. Move another 8,000 here, and then move another 8,000 there, and then so on and so forth, right? So you just kind of keep moving a small amount, and you see that 8,000 gets paid off pretty quickly. Now, we have this calculator right here where all you have to do is just type in the numbers, amount that you want to chunk, your income and expenses, and everything except for the loan you want to pay off. And then you see for this one, it gets paid off in 2.8 years, right? So I don't know if this is a realistic scenario these days, but I know back in 2020, a lot of people had, $250,000 mortgages, maybe $300,000 mortgages in a low 3% rate. But because a lot of people are almost stuck in their home because of the low interest rates, I think this is a realistic scenario for a lot of people. So now what we do is we get this number is 2.8 right here, 2.8, and then I'm just going to do 0, and then mortgage paid off, and 37 divided by 12 plus 2.8, right? So what's this? So this is 5.888 years, and we are debt free. Okay, debt free. All right. Well, that's pretty quick, right? So basically, you learned that the opposite of making minimum payments is essentially velocity banking, because during this whole time, we don't have anything in our checking and savings, and we're not just making minimum payments, right? We're not just making minimum payments. By the way, if you want to see a more realistic scenario, where someone had 22 debts and I think $4 left over, join the YouTube channel. It's only like 99 cents, and then you have access to that free live stream. I think I went over it twice, but I like to keep that under a paywall, right? So I like to keep that under a paywall, and then you can watch it because I'm a greedy SOB. All right, well that's it for today, folks. This is Korean Lanta Mentorship. Have a great day, and I'll see you all in the next video. And hopefully, you know, you'll understand what minimum payments does, or just making minimum payments does, like that nice little lady over there on TikTok. Bye bye.